Hello, today is November 10th, 2023, and it's time for some new stock picks. As always, I'll review the performance of my picks from this time last year, offer a little bit of a analysis on current market conditions and economic conditions, and proceed with some new stock picks and the rationale behind them. So this time last year, I picked 3M, the consumer good kind of manufacturer, like post-it notes and all that nice stuff. The stock was down 21.8%. I also picked Manulife Financial. The stock was up 19.7%. And Michelin, the tire manufacturer, the stock was up 21.5%. The average of those three was 6.5%, and that's in US dollars, including dividends. That compares with 16.8% for the performance of the MSCI World Equity Index, as represented by the URTH ETF, again in US dollars, including dividends. Our picks did not outperform the market this time. We were positioned, and still are, for a potential recession. And the result was this underperformance. However, historically, we beat the market about 68% of the time, and the picks on average do about 4.2% better than the market. I already mentioned we are expecting the possibility of a recession. In my mind, the odds for recession globally and in the US and Canada are about 60%. And in a recession, typically equities go into a bear market with stocks dropping as much as 30% on average before recovering and then making new highs within let's say 3 years. And I believe we may be in this situation again, about 60% chance of that happening, and with the remaining, let's say 30%, like a slow growth and a 10% higher growth and inflation. The consensus outlook may be a little bit different. More people may be expecting higher growth and higher inflation, but there is a number of reasons why I think the odds for a recession are higher than what analysts may be expecting. Interest rates being higher, the yield curve being inverted, and especially the Canadian and European economy being levered to interest rates. The U.S. economy is a little bit less so, because the mortgages in the U.S., residential mortgages have typically 30-year terms. People have locked in their low rates. But the sensitivity for the Canadian economy and the global economy is higher to rates. And as a lot of investors are U.S.-centric, they probably experiencing like a home country bias, if you will. So we're positioning again for playing a little bit of defense with our stocks for the next year. And for that reason, our first pick is going to be a utility company. Lots of good utility companies in the US, in Canada, but this one is a European one. Endesa, symbol ELEZY. They operate in a power utility operating in Spain and Portugal. They have hydro, nuclear, coal, natural gas, oil, solar, and wind. Why do we like this particular utility? The stock yields 8.6%. So that's pretty much the return we expect from the stock. So we don't expect the stock price to go anywhere. But in an environment where there's a possibility of a negative returns for stocks on average for next year, getting 8 to 9% returns is pretty good. Same idea with the next stock pick, British American Tobacco, one of the largest tobacco companies in the world, neck and neck with Philip Morris as to who's the largest. They have brands like Pall Mall, Lucky Strike, Rothmans, Camel in the US. Well, not particularly a good business, very mature and obviously a dying business, but the valuation on the stock is so attractive that it's the odds are that we're going to make a decent return from it. Again, the dividend yield on this is about 9%. So again, we don't need the company's sales to grow or even stay the same, maybe just not decline too much. And we're going to make a decent return from it without taking on a lot of risk. And the third stock is a little bit of an offensive stock in that we can't have a big recession in this stock doing well, even though it's particularly well priced, or maybe it's already expecting a recession and the recession is already priced in. It's Mercedes-Benz Group, symbol MGDDY. The P ratio, trailing 12 month, is only four times earnings. Dividend yield is 9.5%. Price to book is only 0.67. It means it's trading at 6 to 7% to the cost of putting this business together, and which may be close to the liquidation cost, or maybe liquidation is usually lower, but you're getting it at a discount to every single metric. So the market is probably thinking that they're going to eventually go out of business, and there's only going to be one automaker in the world. It's going to be Tesla. So, I mean, it's possible, but right now, because the valuation is so particularly attractive, we're willing to take a chance on this, even in a possibly weakening economic environment. And perhaps maybe the buyers of the products are less economically sensitive than your typical consumer, and they don't need financing and all that. So that's our third pick. As always, if you have any questions as to whether these stocks fit in your portfolio or any other investment questions, please don't hesitate to give us a call. Thank you, and have a great day and a great long weekend. A happy Remembrance Day.